Today, we are digging into a huge story. I mean, one of the biggest shifts happening in enterprise tech. We're looking at a major software and cloud provider, and it's massive, all-in bet on AI infrastructure.
It's a fascinating situation because you're really looking at two completely different stories playing out at the same time. And that tension is exactly why we need to do this deep dive.
What are those two stories?
Well, on one side, you have the company narrative, which is all about explosive, AI-driven hypergrowth that's in the headlines every week. But on the other side, you look at the stock price. I mean, it's been incredibly volatile.
Yeah, the numbers are pretty wild. The 52-week high was $345.72, but the low was all the way down at $118.86. And despite all that, a financial firm is, holding a cautious neutral recommendation on it with a price target of $232.
Exactly, and that's the riddle, right? How can a company be growing so fast in its most important business, yet have Wall Street being so careful?
Right. So our mission today is to get past those headlines about their Q2 fiscal year 2026 performance. We want to separate the real sustainable momentum from the risks that might be hiding inside all that massive spending.
We're stress test the whole story. It's about balancing those spectacular numbers. Yeah. And some of them are truly spectacular, like their order backlog against the, let's call them financial friction points that you find when you dig a little deeper. We're not just looking at the growth, we're analyzing what that growth actually costs.
Okay, so let's start with the bull case, because the numbers powering this AI engine, they are genuinely staggering.
Oh, absolutely. So Q2 fiscal year 2026, total revenues hit $16.1 billion. That's up 13% in constant currency.
Which is solid on its own, but that's not really the headline here, is it? That's just the foundation.
Not at all. The real story, the acceleration, is in the cloud business. If you combine their software as a serve, SaaS, and their infrastructure as a service, SaaS, their total cloud revenue was up 33%. Hit $8 billion.
And even within that, there's a story inside the story.
That's right. You have to break it down further. The true hypergrowth is in the cloud infrastructure piece, OCI. Revenue there grew 66%. That segment is the engine.
And what's fueling that engine? The sources are really specific on this.
GPUs. GPU-related revenue grew 177%. So we're talking about the fundamental hardware needed to train and run the world's biggest AI models. They aren't just, part of the AI boom. They're becoming one of the core providers of the capacity for it.
Which brings us to this one metric that seems to define the entire narrative, the RPO.
The remaining performance obligations, yes. This number is what has everyone so excited. It's essentially the company's backlog. Yeah. All the contracts they've signed but haven't delivered or billed for yet.
And that figure it's almost hard to believe. It's $523.3 billion.
$500 billion, yes. And maybe even more shocking, it's a 433% increase from the year before.
So for you, the listener, what this RPO means is you have this incredible visibility into future revenue. It's not speculation. It's driven by these huge multi-billion-dollar contracts with the biggest names in AI, Meta, NVIDIA, companies like that. It's committed demand.
And this isn't just about them building data centers. It's tied directly to a very specific strategic pivot. They're trying to position their Oracle AI data platform as the core differentiator for the entire company. It's a pretty revolutionary vision.
So tell us about that vision. How does this platform change how AI works with a company's data?
Okay, so the goal is to let all the big large language models, OpenAI's ChatGPT, xAI's Grok, Google's Gemini, Meta's Llama, let them perform really complex reasoning on a company's own private data.
Without that data ever leaving the company's control. That's the key, right? The security and privacy.
That is the number one challenge for any big enterprise right now. How do you use this amazing new technology without your most valuable secrets leaking out and being used to train some public model?
So it's like a secure private brain for the company's AI.
That's a great way to put it. And it connects to their unification strategy. See, the biggest headache for any large company is that their data is scattered everywhere. This platform is designed to unify all of it. Even data sitting in a competitor's database like MongoDB or Snowflake or in another cloud, they want to pull it all into one secure AI lakehouse.
So they're not just trying to be a cloud provider. They're trying to be the central nervous system for a company's entire data operation, no matter where it is.
That's the vision.
Okay, let's just take a breath on that. The growth is real. The strategy is definitely visionary. But, building a $500 billion AI empire, that takes an unbelievable amount of capital. Where is the money coming from to actually build out the capacity for that $523 billion backlog?
And that is the perfect transition. because this is where we pivot from the exciting growth story to the, let's say, the stark financial reality of it all. The pace of capital expenditure, the CapEx, is just massive, and it's creating some serious short-term financial strain.
We saw the beginnings of it in fiscal year 2025. Their CapEx was $21.2 billion, and that spending was so high it actually pushed their free cash flow negative.
Right, negative $400 million. And free cash flow, or FCF, is the cash you have left after you pay for everything, operations, investments. If that number's negative, it means you're funding the business with debt or with cash you already had on hand. You're burning through it.
And it's not slowing down, it's speeding up.
Dramatically.
Ah.
The guidance for fiscal year 2026 CapEx shot up to $35 billion. Just in Q2, they spent $12 billion on CapEx. And that resulted in a negative free cash flow of $10 billion in 1 quarter.
Wow, so they are literally burning billions of dollars right now to build for the future. But how does that square with their commitment to keeping an investment-grade debt rating? How do you spend $35 billion and not just drown in debt?
Well, this is where it gets really creative. They're using these highly non-traditional financing models to soften the blow to their balance sheet. Instead of just going out and borrowing $35 billion, they're using 3 main strategies.
Okay, what are they?
First, they're using a lot of leasing agreements for the actual land, buildings, and power, so they don't have to record the expense until the data center is actually delivered and ready to go.
So it pushes the cost down the road closer to when it will actually start making money.
Exactly. Second, they're getting customers to provide their own chips. This is huge. Completely removes billions of dollars of their own CapEx liability from the books.
And the third?
Vendor rental agreements for the hardware. This turns what would be a massive upfront cash payment into basically a recurring rental fee. And they time those payments to line up with when they start getting paid by the customer using that hardware.
Okay, on paper, that sounds incredibly smart. You keep debt low, you smooth out your cash flow. But what's the catch? Why would analysts still be cautious about this?
Because while the company says this structure means they need to borrow a lot less than the $100 billion some people were modeling, a deeper look suggests you're just swapping one kind of risk for another. You're replacing standard, predictable debt with what you could call hidden liabilities. You are now operationally reliant on a whole chain of outside partners executing perfectly.
So let me see if I get this. The risk is that if one of these vendor rental deals falls apart or a customer is late delivering their chips, the full cost of that equipment just snaps right back onto Oracle's balance sheet, and probably at the worst possible time.
That's precisely the risk. That incredible $523 billion RPO backlog, it's only as real as the physical data centers backing it up. And the delivery of that capacity depends entirely on this coalition of partners, vendors, and even customers all holding up their end of the bargain. It's a very complex house of cards, even if it's built by a brilliant architect.
And this is where the story gets really interesting, because if you pull the lens back from those huge global AI numbers, you start to see some cracks in other parts of the business.
You do. You see it in the international performance. Despite that strong overall growth, Q2 had some clear underperformance in key international markets. In Europe, the Middle East, and Africa, EMEA revenue missed analyst expectations by over 5%. And in the Asia-Pacific region, APAC, it missed by almost 4.8%.
So there's a real geographical weakness hiding under that global headline number. And the executives, they didn't really hide from it. They actually gave a very specific reason.
They did. The CEO pointed directly to a major Salesforce reorg in many regions throughout the world as a factor.
And that's the key, right? The question for you as an observer is this: is that miss just temporary friction? You know, the messiness that comes from reorganizing your sales teams? Or, and this is the real concern, is it a sign of a deeper, more structural weakness against their competitors in their core application sales in those huge markets?
That's the million-dollar or maybe billion-dollar question. Is the AI engine so powerful that it's just masking some stagnation of the traditional parts of the business overseas?
So let's pivot to that applications business. It grew 11% in the quarter, and that was backed by a 14% growth in deferred revenue, so it seems like momentum is building.
And management has a clear story for that. They credit the AI halo effect. The idea that excitement about AI lifts every other product line and their one Oracle sales strategy.
And there were some really strong performers in
Oh,
there.
yeah, you can't overlook them. Fusion ERP, which is, the financial core for so many big companies, was up 17%. Supply chain management, SCM, up 18%. For mature applications like those are excellent growth numbers.
But this brings us to what might be the most important question of this whole analysis. How much of that 11% growth is actually new growth?
Explain what you mean.
Well, we know there's this massive tailwind they've had for years from the legacy migration cycle. When a customer finally moves off an old on-premise system and into the cloud, the sources say it creates a 3x to 5x annual revenue lift. It's a
Yeah.
huge bump.
A huge and somewhat guaranteed bump. It's been happening for years. So the question is, how do you separate the drivers? Is that 11% growth mostly just the result of that big existing migration lift finally happening? Or is it really the immediate payoff from the 400-plus new Aon features they just rolled out?
Exactly, because if it's just the migration, that's great, but that's a finite process. It will end one day. If it's the new AI innovation driving it, that's an engine that could run for another decade. The ambiguity there is the real friction point. We don't know if the AI halo is the true cause or if it's just, a new coat of paint on a big upgrade project that was going to happen anyway.
So to synthesize all this, we're really tracking two different stories at the same time. High-stakes stories. First, you have the undeniable hypergrowth of the AI infrastructure, up 66%, completely changing the company's identity. But it's all funded by these very complex, high-risk, non-traditional financing deals.
And second, you have this slower, much more nuanced story of the core applications business. It's growing, yes, but we don't know exactly why. And we can see from the Q2 misses that it's facing real competitive pressure in key international markets.
So what does this all mean for you?
Well, the company has, I think, successfully positioned itself to be the central nervous system for what they call the agentic enterprise. With this AI data platform,
Yeah.
they have the contracts, they have the vision, and that $500 billion RPO to back up the claim that they will be central to the AI economy.
But, and it's a huge but, their immediate financial health, their stability, it all hinges on executing flawlessly on two things. First, they have to deliver those data centers on time, which depends on that whole external coalition of partners. And second, they have to fix the sales issues and competitive pressure in those international markets. It is a massive, fascinating, and extremely high-wire act. So let me leave you with a final thought to mull over. The company is absolutely committed to its investment-grade debt rating, while also planning to spend $35 billion in CapEx. So think about this. Given that incredible $523 billion backlog of pure, committed future revenue, is the risk of not building the capacity and losing all that future money a greater strategic threat than the risk from the complex financial structure they're using to fund it all today?
The entire future of this massive enterprise rests on the successful, on-time delivery of data centers that are essentially being paid for by a coalition of external promises. That is the ultimate trade-off and a great place to leave our deep dive today. We hope you feel far more informed and maybe a little better prepared to look critically at the relationship between a company's growth story and the real financial mechanics that make it run. Until next time.